one of the reasons why the dollar is so useful as a global reserve currency is because the capital markets are so deep. So once you get dollars, there's so many things you can do with a dollar. You can buy treasuries, you can buy S&P 500 or any of the stocks they're in. There's a extensive private equity. There's a whole continent of dollar-denominated real estate you could buy. There's just a tens and tens of trillions of dollars worth of highly liquid assets you can buy with it that are all in one big regulatory scheme, currency scheme, very liquid, and open capital markets.
Today, we explore Lyn Alden's insights into the dominant role of the US dollar in the global reserve currency landscape. Alden highlights the key factor of the deep US capital markets, offering a multitude of options for deploying dollars from treasuries to S&P 500 stocks. This diversity of highly liquid assets, all governed by a unified regulatory framework, cements the dollar's supremacy. In contrast, Alden points out the challenges faced by other currencies like the euro and China's yuan. The segmented capital markets of the euro and the limited foreign demand for Chinese equities pose hurdles. Alden foresees a potential future competition between the dollar and the yuan on a global scale. However, she underscores the difficulty of eliminating a neutral reserve asset, emphasizing the network effect where liquidity plays a pivotal role. As shifts in payment channels and reserve diversification unfold, Alden predicts that the network effect of liquidity will continue reinforcing the US dollar's global monetary status. With that, let's dive into the video to hear Lyn's full thesis.
Um, the euro has struggled more in that regard because even though you have a shared currency, you have different silos of capital markets, and so none of them are as liquid as US capital markets, right? And so you're still siloed. In China, there's not a lot of foreign demand for Chinese equities or real estate. And so it's like if you're running a surplus against China, let's say you're an oil producer, what do you do with that currency? It's like, well, there's lots of things you can do in the near term with it. You can buy all the Chinese goods. Uh, you can go to the Shanghai Gold Exchange and convert it to gold if you want. There's plenty of things you can do, but just merely holding their currency, and kind of reinvesting into Chinese capital assets is not a very attractive thing to do with it. Um, and then the when you get outside of those three major currencies, it drops significantly. So if Brazil is trying to make their currency a regional currency, how many entities, if they're running a surplus against Brazil, want to hold a lot of that currency and then reinvest it into Brazilian um, capital markets, right? And so that's the challenge with this. I think that over the long term, I mean, you could have maybe like two major currencies that really compete. Like you could have, say, the dollar system and the yuan, Chinese yuan system. You could potentially fracture that into two. Um, but it's really hard to have no neutral reserve asset at all. Usually there's a network effect tendency that makes one dominant asset kind of the underlying one. And that even as you have a more multipolar world, like even as you have payment arrangements that don't use that reserve asset, you have China buy energy from Russia without using dollars, or China buy iron from Brazil without using dollars, or India buying arms from Russia without using dollars, right? I think we're going to see, and we already are seeing, but I think we're going to continue to see de-dollarization of payment channels. We'll see more reserve accumulation, more reserve diversification. Um, but there's still liquidity itself is a network effect. And we're already seeing this manifest. For example, India and Russia are on good trading terms. They were for a while, and they still are, because India needs commodities, Russia makes commodities, Russia also makes arms, and so they're and they don't share a border, so they're not really enemies in the way, or like adversaries in the way that some other entities are. So they've had a constructive trade relationship. But the problem is, when Russia runs a surplus against India, they accumulate all these rupees, and they think, well, what do I want to do with these rupees? Do I want to? There's only so much I want to reinvest into Indian capital markets, right? And so they start saying, well, can you pay us in Chinese currency? Can you pay us in? They start to want to go up to stack to a higher network effect, higher liquidity currency at a certain point. And so that's the kind of self-reinforcing challenge of not having any reserve asset, is that the top few network effects really kind of start to dominate, even as you can. It's not necessarily one asset, but it's not a lot of assets. Is my point that only the most liquid, deep capital market or most liquid markets can really maintain that kind of global monetary status.
In this next analysis by Lyn Alden, we unravel the intricate challenges facing the euro as a contender in the global financial arena. Alden sheds light on the difficulties of establishing new network effects, emphasizing the fractured capital markets within the eurozone. She delves into the recent trends, highlighting how China has been taking market share from Europe and the euro losing ground in reserve diversification. The geopolitical dynamics, particularly the setbacks with Russia and energy security issues, have further complicated the euro's trajectory.
So I mean, that's so far been an example of how hard it is to establish a new network effect. So, you know, it was a very optimistic time 25 years ago when the euro was kind of coming into existence and kind of on the uprise. Um, in recent years, when we see some degree of reserve diversification. So we see a little bit, China goes from almost no countries have reserves in it to maybe 5%, whatever. The dollar's been pretty flat. It's the euro that's been losing market share in the past few years. So, for example, China's kind of been taking market share from Europe, you could say. And there's been a few reasons for that. One is that going back to my prior point, the fractured capital markets make it hard for any entity running a big surplus against Europe to want to know what to do with those euros. So prior to the euro, German debt markets were highly liquid. And after the euro, German debt markets are still highly liquid. And so that's the one everybody wants. When you get into other ones, they suddenly get less attractive. It's like there's a long tail of debt markets that are just not interesting to foreign investors. And even the German debt market can't compete in scale with the US debt market, the size and liquidity there. And so it doesn't fundamentally solve the problem of fractured capital markets. Um, and the the major setback with Russia has also harmed the euro because one of the key benefits of the euro is it allows Europe to buy energy in their own currency. And for a while that was working. And I mean, it still is, but for a while, for example, if you looked at Russian natural gas and other commodities going to Europe, it was increasingly euro denominated. Over time, as that built up for years and years and years, the dollar denominated trade was diminishing and the euro denominated trade was increasing. But now with the war and then with the busted pipeline and with the that whole trend is derailed. And so you're kind of starting from square one again. And it's one of those. It's big enough currency where it's a serious contender to be able to buy energy in its own currency. Um, so it's helping with that problem, but it's not. None of the network effects are making ground. And then now that Europe doesn't really have the energy security that it used to, we've seen, for example, German deindustrialization. So Germany's kind of been the economic powerhouse of Europe. And if you look at, if you're in any sort of energy intensive industry, if you make chemicals, if you manufacture stuff, if a lot of that's been leaving Germany and going to places like China, because the energy costs are just not really competitive anymore, and just future risks of energy shortages or what energy costs might be 5, 10 years from now if you're building a very long lived facility where you want kind of cheaper energy. And so overall, I think that we're seeing a diminishment of the euro on the global scale. It's not really, if there's network effects and you're like in third place, it's just not a great position to be in. Is kind of what we're seeing, um, as well as just internal policy issues that might kind of hamper that, or just bad luck with things like their biggest natural gas provider going to war in Ukraine. Like there's both external things that happen to them, internal energy policies, I would argue that they've taken missteps on, and then just the sheer challenge of trying to compete with leading network effects in money is just hard. So I'm not very optimistic on the euro's prospects for um, globalizing itself more than, say, the high watermark that it's already reached.
Today's journey into the world of global finance with Lyn Alden has been truly enlightening. We explored the unparalleled dominance of the US dollar, delving into the deep capital markets that make it a powerhouse in the global reserve currency landscape. Alden's insights on the challenges faced by other currencies, particularly the euro, shed light on the complexities of establishing new network effects and the impact of geopolitical dynamics. As we wrap up, don't forget to subscribe to our channel for more expert analyses and in-depth discussions on finance and economics. If you found this content valuable, give us a thumbs up and feel free to share your thoughts in the comments below.